At the beginning, you said the two technologies that are dominating the headlines are AI, artificial intelligence, and blockchain. AI is going to fuel the adoption of digital assets. And I'm not talking about cryptocurrencies here. I'm talking about digital money. The announcement from essentially 10 of the biggest banks in the world, Bank of America, Deutsche Bank, Barclays, companies like that, they've basically said, look, if we're going to have a payment mechanism that is smart, and I think this is the important thing, this is about digital money. We need to be together rather than trying to do our own desperate things. But I must stress, I do think the opportunity is not for you and me, it's for institutions. This isn't a retail play. This is very much a business play. We're being offered an alternative of digital money, programmable money, intelligent money, smart money. Think of it as a multi-sig escrow whereby once certain conditions are met, an API can be instructed to make that transaction happen. An IoT device in a ship, and when the ship docks in Athens, then the ship owner gets paid, the duty gets paid. All those different calculations get immediately sorted out.
Hello, I'm your host, Effie Pilarino, and today I'm delighted to have with us a very dear friend and guest that I've been on his show too. This is Johnny Fry. He is the founder and author of Digital Bytes. This is a wonderful weekly that's focused on really applications, global applications of blockchain technology and digital assets. He also hosts a weekly radio show around that content that reaches millions of listeners. Johnny really comes from our industry. He'll tell us a little bit more about that. He's a non-executive director to several blockchain ventures right now. He headed Clearbank's digital asset strategy, and we are here to talk about some news, some great news. First of all, welcome, Johnny. Thank you for joining us.
No, thank you, Effie. Lovely to be on your show. And as I said, I was in your beautiful country a couple of weeks ago in Kefalonia, in Greece. And, so it's nice to see a Greek lady and doing a podcast with you.
Yes, brilliant. And as I said, you have a global voice through your publication and through your radio show, and you've been really talking about blockchain and digital assets when it wasn't so hot, right? Now it is second to AI, I would say. Blockchain technology for financial services is really a very big theme this year. And what I wanted to discuss with you today is the recent news about a consortium, a group of banks that are really global, from North America all the way to Japan, that are planning to launch a stablecoin. In one of your brilliant content pieces, you said that this is one of the most important announcements in the digital asset space since Libra. And we all remember Libra. So let's talk about this. Let's really talk about what is the news, and then we can interpret a bit. Tell us who's involved, what they're planning to do, why this is exciting. We'll deep dive into that afterwards.
Yeah, sure. Thanks again, Effie. And essentially what we're seeing is I think the first thing I think is of note is that in the TradFi world that you and I came from, I ran, having set up a quoted fund management business here in the UK. It was all very much in the 80s and 90s, all about me. My fund was better than yours. My bank account paid more interest than hers. And it was quite insular and very centralized around being bigger and better. In the digital sphere, it's very much about collaboration. It's very much about decentralization. And I think the announcement from essentially 10 of the biggest banks in the world, Bank of America, Deutsche Bank, Barclays, companies like that, they've basically said, look, if we're going to have a payment mechanism that is smart, and I think this is the important thing, this is about digital money. To make this work, we need to be together rather than trying to do our own desperate things. And it does, to some extent, have the hallmarks of Libra. Facebook supported digital currency back in June 2018, when, if you remember, even the likes of MasterCard and Visa, and they had 24 companies joined together. But essentially, the central bankers and the regulators crushed it because they suddenly realized that if someone like Facebook or Meta with a couple of billion people a month logging on started using an alternative way of making payments, then they could lose control. And also back then, blockchains hadn't really entered into the ecosystem like they have now. They hadn't really proved themselves at scale. But no one can
And we
deny
didn't have the regulatory
didn't have the
frameworks.
regulatory, we
Now
didn't have
we
the
have.
infrastructure in terms of digital custody and the on-off ramps. And I look, often people say to me, yeah, but Johnny, blockchain, it's very niche. It doesn't scale. It's expensive. And I said, look at what's happening in America in the repo market. Broadbridge are doing $2 trillion worth of transactions a month. And we're now seeing JP Morgan, Jamie Dimon was a huge cynic of the technology, and now very much the JP Morgan coin with tokenized deposits. The biggest fund manager in the world, Larry Fink, has announced only this week they're going to tokenize everything.
ETFs, so that's trillions, right?
Yeah.
Only BlackRock's ETF universe is 5 trillion. Can you imagine?
Incredible. But even last night, a big Chinese bank tokenized a 3.8 billion money market fund. So institutions are very much on board. And so the two things that stand out, not the fact it's a stablecoin, but first of all, we have the collaboration. And secondly, I think this really underpins that we need D-money licenses, not E-money licenses. E for Echo, just because you have one of these sort of funny things that we carry around, IMO, that's electronic money. It's not intelligent. Whereas digital money, if it's done correctly, is safer than a bank deposit. You don't need insurance policies to say what happens if the bank goes bust, because you haven't got unknown people making loans in all sorts of dubious areas. And that's why we need insurance on bank accounts. Whereas if you're putting your money and you're effectively got a security, it's secured against money held in a vault, money held in very safe, high liquid assets like gilts, treasuries, bonds, central bank deposits, things like that. It's much, much safer than the current banking system. But I must stress, I do think the opportunity is not for you and me. It's for institutions. This isn't a retail play. This is very much a business play.
Okay. So first of all, before we dive into that, let's make clear, Libra initially was going to create a token that's backed by a basket of currencies.
Yes.
Now what does this consortium of the G7 really banks want to do? Is it dollar backed? Is it euro backed? Is it a basket? Do we know?
It's still, first of all, they don't want to limit it to just the founding 10. They're very happy to involve other banks if they want to come into the consortium. But think of it as a family of tokens. So you're going to have a G7 US dollar, a G7 euro, a G7 GBP. And I think the commonality will be the standards, the systems, the process, the infrastructure that they're going to work on. And this will then solve a lot of the challenges of interoperability.
Yes. And they have mentioned that they want to use public blockchains, but we don't really know what that means. Is it Ethereum? Is it Solana? Is it something they come up with, some variation? It's not clear, right?
No, but I think the fact that it's a public blockchain, I think that's quite an interesting statement, because they could have very easily gone with their own blockchain and had their own nodes. That's, if you excuse the expression, it's almost like a little bit like being half pregnant. You can't really be. If you're going to be decentralized, you need to be decentralized, because that gives you the security, and it gives you much more, I think, stability. But I wonder whether what we'll see is, for example, the G7 euro, will that just have nodes just in Europe? Will the G7 sterling just have nodes in the UK, et cetera, et cetera? So whether they'll have the same technology, but I think we're going to see a slightly more intelligent architecture behind something like this, because that's the sort of debates and discussions which the institutions are having. They're very much looking at the jurisdiction of where these nodes are, because if we run into problems, then you don't really want Uncle Sam wandering into Athens and saying, oh, hang on, you've got nodes in New York and the euro stablecoin, we're going to have some sort of say in the matter, or we want some sort of tax take because it's gone through US nodes, and vice versa. So I think that sort of control and the jurisdiction is really important from a point of law as much as anything else.
Interesting. In the complication that these banks that are in this first, at least, batch of the consortium, they're in different jurisdictions, right? We have Japan, we have UK, we have EU, MiCA, and we have US Genius Act. And isn't this a complication? Does that increase the risk that this thing will never take off?
Look, there's always a risk when you're trying to herd cats. They all come together when it's mealtime, but then they all seem to go all over the place the rest of the day. So I don't think it's a guarantee, but I think what it'll do, I do think it will force the agenda once again for the regulators and the central banks. Had this been announced, say, a year ago, I would be less confident. But off the back of what we've seen, look, Christine Lagarde wants to get back, as she calls it, monetary sovereignty. She feels that the debit and credit cards have taken control of European payments to a large extent. And that's one of the drivers behind the digital euro.
Yes.
Whereas in America, I think it's less about the technology. I think it's less about giving people an alternative choice. And it's very much about how do we drive interest rates down? Because as I refer to him, King Trump, we have a proper King Charles, obviously, but King Trump, who came and had an Airbnb at Windsor Castle a couple of weeks ago, he's actually wants to drive interest rates down. And so piling money into short-dated treasuries hopefully will reduce interest rates and help him refinance 17 trillion because he's running out of time. He's nearly had a year and he's got to actually get that debt refinanced and he's got to get the US economy firing all cylinders. So
I guess what you're saying is that all these stablecoin issuers have different incentives, different agendas,
exactly.
right? But by coming together, it's hopefully find a way where all these agendas can coexist and we can have everybody somewhat happy. But Johnny, we've already had in Europe, for example, Societe Generale has issued a euro stablecoin that is open in the market. It hasn't done. And for now, at least the bulk of stablecoins are not used in payments. Where do you think this time is different? How come this time you think it will be different? Let's talk about Societe Generale first.
Okay, you're absolutely right. Over 90% of the current stablecoins are US dollar denominated.
Yeah.
And this is leading to a dollarization. And I was at a conference yesterday and we were talking about the dollarization of the UK property market.
Yes.
And talking to a very senior regulator.
Because of stable coins, is that?
I think it's because of liquidity.
Okay.
Capital goes where there's most liquidity. And we don't have a sterling stable coin here, so you don't have a choice. Yes, you've got one issued by a bank. A lot of the people that are buying stable coins are not really from the traditional world. But that's going to change. And unfortunately, the central banks have been very almost myopically focused on central bank digital currencies for retail. We don't really need them for retail. Banking, between you and I, we can send money to each other, even cross-border, very quickly, very cheaply. But when it comes to larger sums of money, when there's no longer the insurance protection, when it's cross-border, then it becomes a bit more complicated. And what the prize is the current $2.3 trillion a year. And McKinsey reckon that's going to go to $3.2 trillion a year of income generated on payments. 3.2 trillion a year. That's why we're seeing so many fintech businesses. Yep. And arguably, I think one of the most successful fintech business in the world is Nubank, a Brazilian bank. It's got 115 million customers. It's been a massive success. And what we're beginning to see is the role of banks begin to change.
Yes, but Nubank is built on another infrastructure that what we call a DPI, digital public infrastructure. So it's a very different business. Here we're talking about global flows, as you said, cross-border mainly. That's where the bulk of the friction and the intermediate.
Nubank only last week applied to the OCC in America to launch a US dollar stablecoin.
Yes.
So what we're seeing, I don't see this as a switch. You either use one or other. I think that the current banking rails and systems are very robust, very appropriate for certain payments. And we're being offered an alternative of digital money, programmable money, intelligent money, smart money. Think of it as a multi-sig escrow whereby once certain conditions are met, an API can be instructed to make that transaction happen. An IoT device in a ship, and when the ship docks in Athens, then the ship owner gets paid, the duty gets paid, all those different calculations get immediately sorted out, as opposed to all the huge amount of paperwork that's involved.
For me, Johnny, I think of it that we can do whatever needs to be done, the economic activity, not through bank accounts, but through wallets that are smart and include the basic thing. They can hold stable coins, right? But they can also have all these smart capabilities because the smart contracts on a blockchain, and those are impossible to do through a regular bank account.
Correct. And at the beginning, you said the two technologies that are dominating the headlines are AI,
Yeah.
artificial intelligence, and blockchain. AI is going to fuel the adoption of digital assets, not just, and I'm not talking about cryptocurrencies here. I'm talking about digital money. I'm talking about holding your assets, your healthcare data, your travel data.
Self-custody in your wallet.
Self-custody. It must be self-custody. So you're going to have to start thinking about your digital estate planning. Does your partner know where your digital assets are? They know where the deeds of the house, they're kept in a safe with your lawyer, where you're going to have to start keeping a copy of your assets, a copy of your cold wallet with your attorney. So in the event something happens to you, he or she has instructions to notify your beneficiaries. They have access to your passwords. They can carry out your estate in the proper way. And the good thing is, in many jurisdictions, that's outside the probate law because it was a contract done before you died. So it frees up the flow of money much, much faster. So this is very much a monetary infrastructure story where settlement becomes instant and transparent. And some of the larger banks are trying to get in there before the action gets taken away from the tech companies. And I think that's why the Genius Act is banning tech companies. They don't want tech companies to issue OCC-approved US stablecoins, but they do want other entities to do it.
Yeah, but the other players can get involved. It's not only about the issuance, right? There's all sorts of other value-add services that can be created and offered. And players, it's not only about issuance.
It's not, but I think we have to look at, if we look at slightly wider aspect, over 60% of all trading in FX securities, whether it's equities or bond markets, are carried out by algorithms and bots.
Yes.
And it's very difficult to do any algorithmic programmed trading with cash. It's all on an electronic basis. But once you make it digital, you can then use algorithms and AI to make these payments. And this is where I think we're going to see a huge driver of machine-to-machine payments, for example. So you've got producing a widget in Asia, and every time something comes off the production line, money then gets sent back, a little bit like the photocopier model. They give photocopiers, Canon almost give you a free printer, but they make their money every time you go click because you've got to pay for the ink. So you're going to start to see lots and lots of real-time money. And look at the funds market. Let's look at what's happening. You've now got, nearly $3 billion in the BlackRock Build money market dollar fund. That used to get priced once a day and make payments twice a year. Now you can buy and sell it 24/7, and it's making payments monthly. They're talking about going weekly. So from a compliance point of view, what's the best thing for your clients? Something that gets priced once a day and only gives you income twice a year, or something where it's being priced 24/7 and you get your income potentially weekly. There's no competition. There's no competition. And that's why you've seen BlackRock and Robinhood, even the London Stock Exchange, are actually they've launched the digital market infrastructure. So they're offering tokenized private equity and private credit funds. And there's going to be more tokenized equities, bonds, real estate, data. But that's all okay. But you need to have the way to make the dividends, the coupons, the interest payments. You need to be able to buy and sell them and move towards T0. That's what the markets want. That's what the regulators want. And that will release a huge amount of capital in the markets.
But Johnny, my opinion is that we shouldn't be tokenizing existing financial contracts like whatever, a mutual fund and so on, because then we're not really, we're not able to do all these cash flows, the voting rights or other covenants and so on. We need to start issuing natively on-chain. Do you agree?
But it's a baby step.
Yes.
I think.
Yes.
And I believe that the tokenization of mutual funds is the death of the asset management industry.
In what way?
That's $147 trillion worth of assets. once AI is up to speed and we have true agentic and true super intelligence, and we're not far off that now. I would say less than 18 months time, we'll have true super intelligence, computers that can think and act far faster than any human being. You don't need the fund wrapper. So you can strip away the cost of the fund wrapper and do exactly what you're saying and tokenize all the commodities, all the equities, all the bonds, and all those investments. And AI can then create and go back to what our grandparents would have had, which would be a discretionary portfolio management service. They didn't buy funds.
Correct.
But it's impossible for a human to be able to manage that money 24 hours a day, 7 days a week, and understand all the different risks.
So really what you're saying is the mutual fund, for example, is a wrapper, right?
Yeah.
It's a structure that needs all this legal compliance and all the intermediaries in the asset management business, but we can get rid of that and have an automated structuring business of our own.
Well, it's not me. Larry Fink talks about mass customization.
Yeah.
So an AI bot will say, depending on what you're trying to achieve, your risk parameters, your income, your capital, they'll create a unique discretionary portfolio for you.
Yep.
Everyone will be different. So it's only going, look, there's nothing new. The Dutch invented mutual funds back in 1774. They haven't really changed since then. But now what we're going to do, we're going to go back to a discretionary portfolio management service, but not managed by a chap in a bowler hat that gets into the office and the markets trade for 5 or 6 hours a day. You're going to have bots managing your money, looking for all sorts of opportunities. And I think this will unlock a lot of the money that are in post office funds, in bank accounts, because you as a personal investor will be able to start investing into small debt instruments. So ABN AMRO this week have launched the SME desk, and they're looking to be able to offer SMEs tokenized bonds for as little as €250,000. I don't know the figures in Greece, but in the UK, the 4 major banks, they only account for 40%, 40, of lending. The fintechs that didn't exist 10 years ago now do 60%. And SMEs, small, medium-sized businesses, that's 90% of all the businesses in the world. They employ 60% of all the employees. It's very difficult for them to raise capital because of the risks, the illiquidity.
Yeah.
But if you've got super intelligence, it can spot and it can analyze and it can say, okay, I know you've never heard of Team Blockchain, but it's just raised £750,000 worth of debt. Wow, behind it is bank. This is actually quite a safe investment. It's paying an attractive rate. Yep, we'll put a small amount of money into that. So I think this is going to unleash. People talk about a period of superabundance. And as you can probably gather, I'm super optimistic that a lot of the
super optimistic. I must say that we would need a good regulation around open finance for all this to actually happen, because it requires the access to data in order to.
But the regulators will have access to this intelligence as well. They won't be reliant on audits and accounts which are 6 months old, where the auditor comes in and says, how much money do you want to make this year? Do you think we should keep some back in case you get a bad year next year? And all that shenanigans that goes on.
All lagged audits.
It's going to be done in real time.
That's going away. Johnny, I want to summarize the thoughts and the insights around this stablecoin issuance. I think one of the main points is that this is really institutional. Its potential is to unlock huge value in capital markets, really, is what you also.
That's why I think it's an infrastructure. It's an infrastructure story, not a stablecoin story, if that makes sense. This is about helping. We've seen SWIFT looking to work with 3 of the Japanese banks to create a suite of stablecoins. I think the industry has turned almost 180 degrees from, oh, this is bad, to actually we can use cryptographic technology. So arguably these stablecoins are cryptocurrencies, you could argue. But I think we're missing the point by putting a label on it. It's more, what are they enabling? And if they can enable intelligent, smart money, and if they can enable lower risk, because it's not a bank IOU, it's actually backed by an asset, which I hope we're going to see auditors starting to audit, not give assertions. So you can be absolutely certain, but all you got to do is put a trusted smart contract, say, where is the money? Where's the money? Where's the money? As soon as, now report it. So this is why you're seeing Moody's, you're seeing S&P have launched stablecoin rating services. And all this is really positive because we're now borrowing some of the great things from the TradFi and bringing it into the sort of DeFi sector.
Yes. And we have realized through different ups and downs of markets that DeFi is pretty resilient as infrastructure, as an ecosystem, ironically. Correct?
Yeah, very much. And if you, I'll leave you with one thing, and maybe we'll come back and visit this. But for anyone in financial markets, we're very familiar with dark pools.
Yes.
It would be almost impossible for financial markets to operate without dark pools. Some people argue they were created by Bloomberg when they had Tradebook. So if you've got 1 million of Apple shares or 1 million of BNP shares or whatever, you can't just dump that on the market because it would ruin the price. Or if you wanted to buy that number, the price would rise up again. So the dark pools were used to get you in and out of positions. Today's dark pools are DEXs, decentralized exchanges. And these DEXs were responsible initially for what we saw last week in terms of the market going down, but also were responsible for what we've seen as quite a sharp recovery. So I think we should, and I would suggest listeners to go and have a look at Asta. Asta has basically been written on the Binance BNB. Look at on the code, you can see some similarities there. And in a very short time, Asta, which they reckon CZ from Binance is behind it, is doing 80 billion a day.
This
turnover.
is that Binance's DEX.
Yes, it's not, but CZ, the founder of who's not meant to be involved in the market, but he was the founder of Binance, and Binance recently stepped up with about 380 million of compensation. No other exchanges did, but they said, look, to restore confidence, even though we don't think we've done anything wrong, we want to make sure people are put right. But the reason I'm mentioning Asta is because CZ was saying back in the summer, we need the equivalent of dark pools, which are DEXs. And a lot of people said, no, you don't know what you're talking about. That's not true. But most people don't understand what a dark pool is. In the institutional arena, they do. But outside, dark pool sounds almost a bit dodgy, I shouldn't get involved in it. But we need them. And then we need DEXs. And we need these automatic market makers. And the way you provide liquidity is through digital money, through stablecoins. And sorry, that's a long way of saying that's another role that stablecoins will play, or I should say digital money, because we've got central bank digital currencies in some countries, and we're also seeing increasing interest in deposit tokens.
Thank you so much, Johnny. And I will let our listeners know where they can find you and the Digital Bytes and all your activities.